What's good, people? So we have one day left in the tank this week, and with that said, what I'm looking to do is go ahead and put some extra money in your pockets going into this weekend. And I'm going to do that with the best way I know how, and that is using the market, specifically the options market. So you guys are most definitely going to want to stay locked into this one right here, and there's no better way for me to go ahead and help you guys get to the money tomorrow in the markets than to go ahead and take you guys behind the scenes of a couple of the plays that I have taken that has contributed to my options account this year. Well, people, there is a better way. I could go ahead and give you a play and tell you exactly where it's going to go tomorrow, but I've been spoiling you guys too much recently. I know you guys saw the last drop I did last Thursday where I told you Google's going to go to $211 and it hit that to the T. And couple of weeks before that, I told you Hood was going to go to 115. I know you guys saw that, but nevertheless, listen, in this video I'm going to share with you guys tons of gems that is going to serve you so well. So I'm excited for you guys in this one. And right now, guys, the options account is currently standing at 1.2 million bucks for the year. And that being said, it's time for me to go ahead and take you guys behind the scenes of a couple of recent plays that have contributed to the success that you are seeing right here. We're going to start with the last option play that we took, and we took it as a team, guys. Every single play that I get into, best believe the whole team is right beside me running it up. And this was our last play right here, and this was none other than Uber call options. Check out, look what we did. We generated 118% running it up, 64,000 bucks and some change. Okay, people, but let's take it to the charts now. With Uber, I want to show you guys where we got in, where we got out. Listen, we got into this around 91 bucks. We took it all the way up to the 96 buck mark, and that's what went ahead and generated the profits that you're seeing right here. Now, here's the thing. I want to let you guys know the technique, all right, that we used in this specific example in Uber that I want you guys to take to the markets as soon as tomorrow was to go ahead and extend out the date of the option contract. Check out the option chain with me. Listen, this is where all the magic happens. And the first thing you guys are presented with is the dates that you can select for the option contract. You can see it right here. We can go for the August 29th. We can go for the September 5th. We can go for the September 12th and onwards. So this is the first important decision that you guys are going to make when you're operating in the realms of the options market. And oh boy, is it an important decision. Now, here's the thing. A lot of you guys, especially the beginners, I don't want you guys to get lured into the fact that the 1 week options are going to be the cheapest options that you can get into. But here's the thing. The options that we got into Uber, they were 2 weeks. Okay, so we skipped the 1 week, we went straight to the 2 week options. Now this means that they're going to be a little bit more expensive, probably about 50 bucks more than the 1 week would have per contract, but it was a very, very successful decision. And I want you guys to know that a lot of you guys would actually hit a lot more success in the options market if you just extended 1 more week out. Okay, so just selected those 2 week options. They're going to do so much for you in terms of improving your consistency and your profitability in the options market. Because here's the thing, people, the Uber trade that we went into for the first week, it didn't do anything. It was only in the second week that's when we started to see some motion, and that's when it started to go ahead and generate these profits and run it up all the way to 118%. Okay, so as soon as tomorrow in the markets, when you guys are out there, I want you guys to know it's the 2 week options. That's going to give you some more time, some more room for the play to go ahead and materialize and get to your expected price points. Okay, so that was a technique in Uber, but there was a lot more that we took as of recent. Okay, because the next one you're seeing right here, all right, the trade before Uber was none other than our Hood call options. Check it out. We ran out 52%, netting 24,000 bucks in profit. Let me take it to the charts and show you guys where we got in, where we got out on these ones. All right, so with Hood, what we did is we got into these at around the 108 level, and we ran it up to the 114. Okay, that's what went ahead and generated what you're seeing, these magnificent returns for myself and the whole team. Remember, anytime I'm getting into a play, best believe the team is right beside me running it up, right? We do it as a movement. We do it as a unity over there. But let me go ahead and tell you guys the technique that we used in this instance right here. And that was, we used what we call the ADR. Now that stands for average daily range, people. And let me give you a little bit of insight into what that is. Every single stock out there in the market is going to have its own different ADR. What's an ADR? An ADR is the amount that we expect the stock to move in a day. Okay, now here's the thing. In the case of Hood, the ADR was 6. Okay, now that is significantly higher than most other stocks out there in the market. Let me, as a comparison, people, check it out. The ADR on Uber is only 2. Okay, so where you had an ADR for Hood of 6, the ADR for Uber was 2. So what it means is on a good day, we can see a $6 increase. On a bad day, we can see a $6 decrease. And on a normal day, we can see it move up 3 or move down 3. Okay, so let's say Uber is around 100. We can expect it to move up in a day to about $106. But let me show you guys how we use it and how we use it to our advantage. Given the fact that the ADR for Hood was 6, meaning we can expect in a typical day a $6 increase, and we expected the stock to move up, right? We actually went ahead and pushed out our strike prices by a couple of dollars out of the money. All right, so check out the option chain. Now, instead of selecting an at the money option like a 103, so it was about 108 when we actually took the trade, we actually pushed out the strike to about 111. All right, so we gave it a $3 increase on the strike. What did that do? Well, it meant it decreased the amount we had to pay per option and increased our profits on the exit, people. So listen, the ADR is a magnificent tool that you guys can use to your advantage as soon as tomorrow to be running up in the options market, people. So let's get to the next one, because the play before Hood was none other than our Google options. Check it out. Listen, people, we ran it up 167%. I know the team in the building remember this play because, listen, it was scenes all round on this one. We ran it up $58,000 in profit. And I want to let you guys know, as a matter of fact, before I let you guys know, let's go to the charts. Let me show you guys where we got in and where we got out. Okay, so take a look at Google. Now, we got into these ones in July, and we got into these ones when it was about 170, and we got out of these at about 180. Okay, so got in about 170 down here, got out about 180, 181, 182. Now here's the thing with these Google call options that we entered into, we took advantage of what we call a short squeeze. And I want to let you guys know, short squeezes are magnificent opportunities for you guys to go ahead and replicate the results that you are seeing right here that we hit on our Google play. What's a short squeeze? Well, a short squeeze is this. Let me go back to the charts, right? So let's say we see a dip in the price like we did for Google, okay? You see these dips. What's happening when we're getting these dips, right? Like this one right here, is the shorts are piling on, okay? So what they're doing is they are borrowing the stock and they're selling it right at that price point. So let's say they go and sell it here, boom, at, I don't know, 202, okay? Bear in mind, we got this a lot lower last year, last month. It was around 170 when we got in, but the shorts would have been piling on here at like 199. They would have borrowed the stock and sold it here at 199, expecting it to drop further to, let's say, 190, to buy it back at 190. That delta is their profit. The difference between where they sold it at 199 and where they bought it at 190, that's a $9 profit per whatever, per stock, right? Now here's the thing. When you're able to identify and recognize that price isn't going to move lower anymore, and it's actually going to flip script, reverse higher like it did for Google when we got into these options back in July, and it continued pushing higher. Well, what's going to happen to the short squeezes? Well, listen, they're all going to be stopped out of their position, and as a result, they're going to have to force to buy back, okay, once they're triggered out. And what does that do? That creates a flood of buy orders into the market. When you get that flood of buy orders into the market, it shoots the stock higher. So that being said, if you're able to recognize a short squeeze event, jump into the options market, run up the call options, listen, people, the scenes are going to look like this with 167% on the play. Now, the last one, all right, of the recent plays that we took, okay, the play before Hood was this one right here, and this was on none other than Mara. Okay, now check it out. Let me show you guys what we're working with here. On this one, we went ahead and ran it up 73%, people, netting 31,000 bucks in profit on the play. Now, the difference here is that these were put options, and this is a healthy reminder to you guys that in the options market, not only can you benefit when price is moving higher, but listen, you can make a hell of a lot of money when price is moving lower. And that's exactly what we did right here on these Mara options. Got into these put options and we ran it up big time, people. So listen, it was scenes all round as we got into these Mara options. And let me show you guys the entry. Let me show you guys the exit on this one right here as well, so you guys know what we were working with when it came to Mara. So check it out. With Mara, we got in right here pretty much towards the peak, around the 19 buck mark, and we took these down to the 17.50, and that's what generated the profits that you are seeing on our Mara play. Not only, okay, did we take it down, but I'm gonna let you guys know the technique in this case as well, and that is we took advantage of what we call a low IV. That's a low implied volatility. So check it out. Let me show you guys. All right. So this is the Mara option chain, and you guys can see that top right, we've got what we call an IV percentile. That just shows you how cheap or expensive these options are right now. The lower the number, the cheaper they are. The higher the number, the more expensive they are. And when we got into those options, the IV percentile on Mara was in the 40s. Okay. Right now you can see a 62. So it's higher relative to where it was when we got in. But here's the thing, if you're able to capitalize on these cheaper options, okay, that's where the IV percentile is low, below 40, 30s, 20s, 10s, that's an amazing time. Okay, it means that when you're in play, you put yourself in a position to benefit for what we call IV expansion. Okay, because as the IV increases, the option price also increases too, meaning more profits for you. So with that intel and with that information, I want you guys to take it to the markets tomorrow, put it into practice. You guys recognize and see the things that I've spoken about today. You guys are surely going to be on for a win. I want you guys to come back to this video and let me know how you got on. People, that's the video for today, and I'll see all of you guys on the next one.